Runge. Welcome to the episode. My first question, as I just said before we came on, where is that name? What's the heritage of your last name?
That's a good question. I think it's Danish, but
Okay.
there's a whole history there in my family that I don't really know. There's sort of broken connections of generation or two back.
Heinila is not an easy name for many to pronounce. It seems clear as vanilla ice cream to me, but many challenged with the pronunciation of it, and it's a Finnish name.
Okay.
Interestingly enough, Hawaiians, for whatever reason, they pronounce it like it just rolls off their tongue. It's beautiful.
What sounds like Howley is why.
Yes, that's exactly right. Their dialect just speaks to it very, very well. Anyways, we're getting off topic. Today the conversation is all about Bitcoin. You are an author of a book. I do not want to steal your thunder. I would also like to give you the proper opportunity to give us a little bit about yourself, share a little bit about your background and what led you to the conversation, really the topic that we're going to have today.
Yeah, thank you. I'm happy to. My book is called Bitcoin and the Family Office, an intelligent introduction for the Ultra Affluent. And that's my first book. Very happy, proud of that work and effort. My background, I started in this business in 2005 at a broker-dealer. And it was a very small, no-name broker-dealer. Although it was national, it was a boiler room type environment. Not the type where we were stealing from people as per the movie, but it was definitely one of these high-pressure pressure cooker type places.
Transaction oriented, high commission driven, this kind of thing. Not necessarily
100%
planning. We're not doing planning for people.
That's exactly right. We were slinging commissionable proprietary mutual funds. And that was okay. Leave the ethics of that aside. What was the hardest part for me about working there? I was brand new to the business. I'm like 27 years old. And they said one of the interesting things that happened as I worked there for 3 years, and their niche was public school teachers. And what I found was that market was totally saturated. I was in Beaverton, Oregon. This firm had already saturated that market. So one time when I couldn't find a school district to call, I was calling Tillamook. And I thought that Tillamook's a town out in Oregon. I thought that's a good in. I'll find a little blue ocean there. Yeah, good cheese. Yeah.
So I've actually been there because I've been to Manzanita.
Okay, Manzanita, little small town.
Beautiful little beach town.
Yeah. So I'm trying to call Tillamook, and evidently this other rep hears me, and he comes ripping around the corner. His name's Billy, and he goes, "You cannot call Tillamook. That's my area." And he was hostile about it. And I was like, whoa. And so what I did was I just kind of broke the mold. I was talking to my mom about it, and she was in real estate sales. She goes, "Just cold call the phone book in Madras." And Madras is my hometown. So I printed out from whitepages.com the entire phone book. It was like that thick. And back then you could do that. And I just started cold calling the phone book. And the cool thing about that was it was a blue ocean. There was no competition, but it completely broke the mold of what this company said to do and said would be successful. And I didn't even care. I just did it anyway, built my business. And that high pressure environment eventually got to me. And I could do a whole podcast about just the psychology of that environment. But anyway, I left for Waddell & Reed, which was a much more functional environment, mid-tier level firm.
Right.
Stayed there for a few years. The pressure that started to build there for me was we're still in the commoditized space. I'm offering the same mutual funds and fee-based accounts that literally everybody down the street is. And I felt like I couldn't set myself apart, and I didn't know how. I just felt kind of a yearning. So anyway, I went independent and established Veritas Wealth Management, at the time known as Veritas Wealth Management. Ultimately, still didn't feel like I could distinguish myself. And I just didn't have much passion for discussing a Vanguard S&P 500 fund. There's like nothing unique about that, At the same time, I was studying economics the entire time as a parallel just because I liked it. And the problems that came into my mind that I sort of realized is that when the government took the US dollar off the gold standard, it wreaked havoc. And so I'm studying Austrian economics. And I couldn't solve that problem. And I didn't know how to merge that with my business. Like, what do mutual funds have to do with the gold standard, you know?
Right.
So at some point, my wife sends me a video discussing Bitcoin. And she had no clue that I would be interested. And in about an hour's time, on a rainy Portland Saturday morning, when I was driving out to go to my regular whitewater kayaking expedition, that was a standard wintertime Saturday thing for me, I listened to Robert Breedlove make the case for Bitcoin. And it alleviated every tension I had about the US dollar going off the gold standard. And from that point, I was a believer in Bitcoin. And then I just dove down the rabbit hole. At some point, I built a little Bitcoin advisory service for my existing clients. This was long before the ETFs came out, but I helped them buy non-KYC cold storage Bitcoin, which was a unicorn at the time and still is a unicorn. And so that was kind of my journey. Then the ETFs came out. We built the downside risk mitigated portfolios. I started working in the institutional space, family offices and things. And then the rest is history. I renamed the firm Veritas Bitcoin Strategies, DBA Family Office Bitcoin, wrote my book, and here we are.
What's interesting, as I have read through portions of the book and conversations that you and I have had, it seems as though your thesis is, and the framework is positioning, Bitcoin less as like this kind of speculative growth asset, tech trade, using the word, the more you learn about digital assets, the less the word crypto makes a lot of sense. And it's more as this monetary asset, a long duration store of value, really a hedge against fiat debasement. You just touched on that a little bit, and systematic monetary risk, right? I mean, is that really the basis?
Yeah. I mean, you pretty much made the overarching meta summary right there. What else is there to say?
Right. I've done something right. Look, part of this is, let me just unpack this. Part of our journey and commitment to even the podcast is having an appetite for knowledge and continuing to learn, have an open aperture and an appetite for just hearing other perspectives. And if nothing else, it's additional knowledge and maybe some enlightenment.
Yeah. Yeah.
So go ahead and just unpack for a few minutes, if you don't mind, either anything that I just said in terms of the thesis, or maybe the high level talking point begins with why Bitcoin and not the term crypto, whatever that basket means.
Yeah. Well, I'll attempt to answer all of that in the same exact several next minutes here, because I think the answer is kind of the same. Okay. And disclaimer, what I'm about to say is not a promise of investment performance. It's not a promise of Bitcoin being adopted as either a store of value or a currency. I don't know the future, but what I can talk about is in terms of making an argument and my opinions and my beliefs. Okay. So fair warning.
Good,
so, okay. Having said,
now,
yeah, absolutely.
Point, what is discussed here is from my perspective, right? This is a learning pursuit. This is an open conversation.
That's right. Yeah, we're not making I'm not making the definitive word here, but I'm attempting to present the reasons that I was persuaded as to why Bitcoin is what it is. So yeah, absolutely. So diving in. Okay, so it's like if we just start talking about Bitcoin and go, is it good or bad? Should we buy it or shouldn't we? We're missing a whole huge part of the conversation that preceded it. And that part, the context is extremely important. So if we're going to talk about, okay, so like we all know when we're in sales, if I walk in the door and start presenting my product as the solution, the client needs to understand the problem before they're going to understand the solution. So we have to discuss the problem first. The problem is that in the history of money, and money can be broken down into two separate categories: store of value and medium of exchange. Store of value is, think of gold. It's where I'm going to put my money so that it increases in value over time, because I don't want to spend it. I just want to store it. Medium of exchange is the currency that I use to go buy a gallon of milk. So if we think of the history of money, And so in the whole history of money, there's never been a fully, absolutely scarce, completely sound money. And what I mean by sound is, really scarcity. Gold is the most scarce in that it's difficult to reproduce, but I can still go mine more gold. There's still more of it to capture. We've used seashells in the past as currency. And then when an explorer on an island discovered that, hey, there's all these seashells of like kind on another island, goes and collects them all, brings them to the other island that uses the seashells as currency, you could double the money supply and collapse the economy. And that's actually a historical example. So that's been the problem with the history of money, is working towards soundness of money. Okay, so now if we take the United States, from 1800 to about 1913, inflation wasn't really a thing. Rising prices that we just eat, drink, and breathe in our daily experience, early Americans didn't experience that. 1913, the Fed is created. And from 1913 to today, the dollar has lost around 97% of its purchasing power. A significant move forward in that is in 1971. So it used to be that if you had $1, you could go redeem it for a certain amount of gold. And so we were on what's called the gold standard. Some people to this day still think that we are on the gold standard. There's a lot of confusion about that. But in 1971, the US is 6 times more in debt than we had the gold reserves to back it up. So Nixon goes on TV. He temporarily suspends the dollar from gold. And so here we are 50 plus years later, temporarily suspended. And so from that point, government debt, inflation, and a whole host of other things basically skyrocket. And so the purchasing power of the dollar dwindled tremendously. Okay, so what the dollar is soft money. It's soft currency. It's money backed by nothing other than the promises of the US government, and some would argue oil. It's like the petrodollar. Okay, the problem there is that if I've got $100,000 in the bank, and let's go back to 1913, I put $100,000 in the bank, 100 years from now, 2013, I'm still going to have the same $100,000, but it's going to be worth 3% in terms of purchasing power of what it was. That's a problem for people who want to store value. And so what had to happen is we have to put our money in stocks, bonds, real estate, gold, et cetera. Okay. Now, fast forward.
Hedge inflation and just time value of money. And
that's right.
Yep.
That's why we have a job as investment advisors, because we need to help people battle that inflation monster, right? So the reason, if we need to dive into a little bit of the history of why the dollar went off the gold standard, first of all. Okay, gold in its nature, and this gets into the soundness of money, gold in its nature is really heavy. And so you can't really move it. You could carry around some gold coins in your pocket and buy at the local merchant. But when we're dealing with big dollar amounts, let's say $100 million worth of gold, it's very difficult to move from New York to Dubai without a security team and a ship. It costs money. You got to fuel the ship. You got to store it when you get there because it's so bulky. And so the inconvenience. Inefficient. It's very inefficient. That's a good way of summarizing it. So what we did was we centralized the gold in vaults and issued paper IOUs against it. A huge part of those paper IOUs were the US dollar. Well, what happens is governments tend to want to centralize all the gold. They want to capture the gold wherever they can get it. And they do that in wars. The government had all the gold, or a whole huge ton of it. And then what governments, not just the US governments do this by their nature, is they get out over their skis. Governments tend to overspend. And so when they get too far out over their skis, they have to break the link from gold to their currency. That's an inevitability, and it's driven in part by gold's weight. So every single time, so some people say, we should just go back on the gold standard. It's a great idea, but we can't put that toothpaste back in the tube.
Right.
And so the one of the key problems there is the inefficiency and weight. Gold has a weight problem. It needs to go on a diet. And so now fast forward to Bitcoin, finally. Bitcoin carries 2 key characteristics that are designed to address the issue. First of all, it's absolutely scarce, which we can get into in just a second. But second of all, it's weightless. It's literally stateless. It exists in cyberspace, not in the physical realm. And so the weightlessness of Bitcoin allows it to be transported easily. I can move $100 million of Bitcoin from New York to Dubai in roughly 10 minutes. And I can do it at 11:30 on a Saturday night with a beer in my hand, and I don't need a security team. Nobody has to have a gun to protect me, et cetera. So Bitcoin was designed to address basically a broken currency. When Satoshi Nakamoto released Bitcoin to the world, the very first block of transactions had inscribed on it, Chancellor on the brink of second bailout for banks. And that was in 2009, right in the housing crisis, right in the midst of all that mess and trouble. Satoshi knew what he was doing, and he made a cryptic message on purpose to basically signal, hey, this is an alternate monetary system because the current one keeps getting the whole world into a mess. That was the idea.
Interesting. So you mentioned a batch. This is maybe a little bit off topic, but there's these halvings and there's these, let's talk a little bit more about the finite quantity of Bitcoin. When does that happen, and how does that happen?
Yeah. Okay. So Bitcoin at the real base end of the day, base layer, is merely a protocol. It's computer code, which freaks some people out because it's like, you're asking me to put my money into computer code. Right. Well, yeah, actually, yes, because it's math, and you don't have to trust a third-party intermediary. It operates according to a set of rules that will not change. So when we talk about scarcity, if we take relative scarcity of gold versus the absolute scarcity of Bitcoin, first of all, what do we mean by scarcity? Scarcity means there's less of a thing than there are people who want the thing.
Right.
All right. So, okay, oxygen is valuable to human life. It's a necessity for human life, but oxygen is free. You can go outside and breathe it for free. Diamonds are not necessary for human life, yet they cost a whole lot more than oxygen. Why is that? Well, it's because oxygen is utterly abundant.
Right.
Diamonds are scarce. There are way more people that want diamonds than there are diamonds that exist. And so supply and demand dictates that creates a rise in price. Okay, so now talk about scarcity. Gold is an asset that does respond to market demand in the sense of if there are enough people that want the gold, then the miners have incentive economically to go mine more of it. So it's responsive. The key word there is it's responsive to market demand. Bitcoin is utterly unresponsive to market demand, which could sound like a bad thing, but it's a good thing because there will only ever be 21 million Bitcoins in existence. So supply cannot be increased if demand continues to go up. That's the only asset on earth that's like that I know of. Absolute scarcity is what we call it.
Right.
That means that the only other flex point has to be the price. So that's the idea with absolute scarcity. And that's one reason Bitcoin is unique, because the world has never seen an absolutely scarce asset before. So it's a unique innovation in that regard. Did that answer your full question? I feel like there might be more.
Yeah. No, it's very helpful. I think when you think about arguments for, or the cases that support Bitcoin, let's just, you would say they've solved the problem. If I'm being unbiased, I'm saying it's a legitimate attempt at solving the monetary challenge that'll exist in the world, further exacerbated or compounded by the fact that you're really competing. You've got two forces competing, backed by US dollar. If it's not US dollar, what ends up taking its place, and the challenges that we're faced with gold. You also have this world of other, and I like to use the word digital assets. I think it's a more appropriate term as opposed to just this crypto term.
Feels more responsible to say that.
Yeah, I mean, what Bitcoin does, I think, is help take away some of this speculative, in other words, which digital asset?
Yeah, that's the question, right?
That's the question. And Bitcoin seems to be the well, look, it is the proven leader in this case. It is also decentralized, correct? In a way that many other digital assets are not.
That's correct. That's right. And I want to comment on something that you said. You said that I would say that it solves the problem. I'm reticent to say it with that much certainty, simply because I don't know the future. What I can say is it's designed to solve the problem for sure.
Okay,
so I'm actually,
so we're in the same. That's great. Thank you for clarifying that.
Yeah, absolutely.
So I guess what are some other things from your perspective that maybe we can highlight and showcase that differentiate Bitcoin from the other broader digital asset crypto ecosystem? Because there's so much. And from a financial advisor, wealth manager's perspective, as you touched on, what we're seeing is an incredible amount of ETFs and packaging of diversified buckets of digital assets, as opposed to being purely focused in one asset class.
Yes. I mean, that's the question I get even at the family office level. People who have $1 billion are like, I say Bitcoin, they hear crypto, they go, oh, well, that's good, but which crypto? I have a friend who I don't know what he makes. He's worth a lot of money. And he said, his argument for years as we drink a beer together is like, yeah, okay, but which of the cryptos is gonna, and it's really not a question, it's an answer,
Right.
So yeah, it's like, okay, you will hear Bitcoin people say Bitcoin, not crypto. And there's a whole huge thing underneath that needs unpacking. It's because if we look at what Bitcoin was designed for and the thesis behind it, what we see is that there are, 3,500 other cryptos / digital assets out there. None of them are, very few of them are attempting to address that same problem. There are other spin-offs of Bitcoin called like Bitcoin Cash and things, but so far the market has not shown that it likes them. It seems to prefer Bitcoin over spin-offs of Bitcoin. But there are other cryptos entirely like Ethereum or Solana or Dogecoin that are not even attempting to address the issues that Bitcoin addresses. And so I don't see those cryptos. Some of them I think could have legitimate utility. Like XRP is attempting to be a payment system.
Mm-hmm.
Other cryptos are attempting to address other things, but none of them are really even trying to present the same sort of monetary thesis and solution that Bitcoin is trying to address. So it's where we're at and I see this in our industry all the time. I don't begrudge it by any means. It's why I have a job. Is when I say Bitcoin, people hear crypto. And then when you see discussions on stage from experts, they will talk about which cryptos to buy. And what they're thinking about it from a categorical point of view is they're placing it into the same category as they do something like stocks. They're thinking of it as a trading asset. Where I come from is I don't view Bitcoin as a trading asset. It's not like which is going to go up in fiat terms. Fiat meaning the dollar untethered from gold. Which of the cryptos is best so that I can make the most amount of fiat? The question is, which asset potentially allows me to step outside of the current monetary debasement system and hold sound, hard money? And I think Bitcoin is the answer. So I don't think so it's so easy to lump them all together because they are cryptocurrencies because they're encrypted and they share a lot of things similar, computer protocol, et cetera. But when we really dive deep down the Bitcoin rabbit hole, we find that it's utterly, completely distinct from other cryptos, real estate, gold, stocks, bonds. And when I say that, I have to be really careful. I'm not trying to say this is the latest, greatest thing. You should buy it. It's going to go up. That's not what I'm saying. I'm saying in terms of its structure, it has certain characteristics that other assets don't. At the same time, so does real estate. So I want to try to be fair and balanced.
Yeah, no, and I appreciate that. And I think that's so the key takeaway here is that one, we should definitely isolate, decouple Bitcoin from the rest of the digital asset, crypto, asset class as a whole. There, because it is distinctly unique unto its own, separate from most all others. The other part of this is, correct me if I'm wrong, is all you're suggesting is that this has a place, it has an allocation in certain households, in certain portfolios. This is a great time to transition now into family office conversation. And what's interesting here is, first of all, understand the perspective and the way that a family office operates and thinks differently. What are their focus? Their focuses are, I would think, right? Instead of thinking for me and my lifetime, a family office goes well beyond. We're talking multi-generational strategy, I would think, right? It's long duration capital. It's preserving purchasing power across not just my lifetime while I'm living the matriarch or patriarch of that family office. It's generations to come. Well, that's a big difference in perspective. Ultra wealthy families, they already own all these things, I would presume, or most of these things that you just touched on: private equity, real estate, commodities, stocks, bonds, mutual funds, art, gold, all the above, right? I mean,
yeah, and then some
enters that conversation. Really, I think is just another. It's almost like it's a non-sovereign asset, right?
Yes, it is. That's exactly what it is. It's sort of grassroots. It's non-sovereign. That's the best way to describe it. Meaning, it didn't start out by being created by a sovereign entity like a government. It started sort of from the ground up, and the vast majority of Bitcoin holders are, and at the beginning were, regular people. And most assets are introduced from the top. The sort of elite get hold of them first, and then the people get the rest of it. Bitcoin is the exact opposite. It stood on its head. Yes.
So let's talk a little bit from your perspective and your experience on family offices. You know, things that come to head is what differentiates them from the normal quote unquote investor. What separates their allocation of Bitcoin from traditional investors? Is there?
Yeah, in some ways, yes. In some ways, no. It's a really thoughtful question. The thing that makes family offices the same as everybody else is that they're humans, and we're all humans. We all want to preserve our wealth. Family offices tend to focus the vast majority of their time on thinking, how can I preserve this wealth? As opposed to, say, a retail client who works as a school teacher or a firefighter. Well, they've got to focus on their job. And so they can't specialize and focus in on their wealth. A family office might be somebody who exited a very successful business for $300 million. And now, instead of running that business, they are the ultimate overseer of their wealth. And as you can imagine, 300 million, a billion, 40 billion takes a lot more time and dedicated effort to pay attention to. And so I would say that's probably the key difference. The key thing that's maybe different, but the unique, I'm mincing my words. The tie that does bind is that nobody wants to lose money. Right. Regular people don't want to lose money. High net worth people don't want to lose money. So capital preservation is a key goal. One thing has been my experience is that when I would speak to retail clients, I've been 20 years in the retail space. A lot of times what I would hear that used to irk me is, well, I'm going to spend this money that I've built up and my kids are going to get what they get. Meaning I'm not going to try to focus on transferring this down to the next generation. And I've been trying to think in third to fifth generation transfer terms for years and years, not just in terms of wealth, but in terms of values. That's, I think, so key. And that's for me personally why I like the high net worth, ultra high net worth space. Because what I find is that your values shift when you have all this money. And I've also seen that, contrary to narratives, Hollywood narratives, maybe even media narratives, the majority of family offices that I've seen and interacted with are very philanthropic. And they are now mostly focused on trying to do good for the world with this money that they have. Right. So that's just kind of some contrasts. And that's the thing that I really appreciate is I want to make the world a better place. I think Bitcoin makes the world a better place and does good for underprivileged people as well as privileged people through free market economics and capitalism. And those are values that I align with on family offices.
So let's now, that's very helpful. Thank you. What I'd like to do, let's transition into some questions. And some of these are going to be objections that we hear or just not necessarily positive comments. Let's shed some light. So for example,
let's go.
Let's talk about the correlation or lack thereof, right? So to this point, Bitcoin hasn't expressed itself as a decoupled asset of I'm going to use the broad term markets. What do
stock market, et cetera?
Yeah. Is it because exactly? Is it because our eye is focused on the wrong thing, or what's happening here?
Well, I think that what has happened is that as Bitcoin has entered what we might call arguably its institutional phase, i.e., when the ETFs launched, now you've got BlackRock buying up like billions, and the ETFs collectively buying up billions of Bitcoin. And categorically, the vast majority of folks buying an ETF are still thinking of it like a trading asset, the same way you'd think of S&P 500 ETF. And so buying and selling happens from a trading perspective. When the market goes up, people want to buy it. When the market drops, people want to sell it, which is for some reason the exact opposite of what you're supposed to do. But that's how people tend to behave. Okay, so now the Bitcoin market has entered, it's given access to a whole host of people who I would argue probably haven't put hundreds or thousands of hours of study into Bitcoin, but who are nevertheless buying this ETF. That is generally going to start acting in the exact same way that an S&P 500 ETF acts. It's going to go up and down with sentiment. Whereas let's just say, so a huge amount of Bitcoin wallets with OG Bitcoiners holding Bitcoin on an address, a huge amount of those wallets have not had a transaction in over a year, meaning that a lot of OG Bitcoiners are buying and holding the asset. And I think it's because they believe in its core thesis deep down. And so they're just going to hold on to it through thick and thin. So entering, it's a roundabout way of answering, but entering the institutional phase has, for that reason, created more correlation with different markets, probably NASDAQ, tech, S&P to some degree. So I think that's partly why we're seeing a lot of correlation, at least at this present moment in 2026.
Yeah, you make a good point. It is the correct index would be more of a tech-oriented index like the NASDAQ versus something like the S&P 500. And I guess one of the closing questions on this is, does correlation invalidate Bitcoin's thesis?
I don't think so, because if it's like how you enter the frame. If I enter the frame and agree to all the assumptions of a trading asset frame, that's completely different than entering from a monetary debasement alternative asset frame. Right. Yes.
So it depends on part of this is, and correct me if I'm wrong, like I think, okay, certainly in times of when you timeline it against the life of currency, right? Bitcoin is still immature. It's got to be still in the early years. It's not fair to say that it's fully mature yet, right? Not Correct. All of Bitcoin has even been released. So the story is still evolving here. You make a very good point. You've got institutional application occurring in real time. All of that is unfolding. And the other part of this that I would say is, for the most part, Bitcoin is currently mostly used as a store of value. Yes, it can be used as an exchange of goods, but relative to the total value of Bitcoin that exists in the world, I would think it's a very small percentage that is deployed for exchange of goods versus store of value.
Yeah, I think where we're at in Bitcoin's life cycle is definitely it's being considered more as a store of value than it currently is as a medium of exchange. Now, there are plenty of Bitcoiners building the rails and infrastructure to be able to pay with Bitcoin on a daily basis. For example, Square, the payment app, has released the ability so that any merchant who uses Square can accept payment in Bitcoin. So Bitcoiners are trying to create it so that you can do that. And the advantage there, by the way, is that you bypass the bank and bank fees. And so a merchant can offer discounts to people who pay in Bitcoin, thus making themselves more competitive. But yes, where we're at, I think, as far as its sort of adoption arc, again, not trying to project in the future that Bitcoin will be adopted, we don't know. But what we can look at so far is how the story is unfolding. And yes, store of value, long-term reserve asset, as opposed to if we had to put a binary on it. I don't think we have to put a binary on it, but if we had to, store of value, that's what it seems to be trying to compete as right now, as opposed to it's going to replace the US dollar or become the world reserve currency. Maybe it will, and that might be fun, but right now, no.
So let's talk a minute about intrinsic value. And things that come to mind is, for example, like, does gold have intrinsic value? Does a fiat currency have intrinsic value? What is the response to someone who says Bitcoin has no intrinsic value?
Yeah, we'd have to define intrinsic. Oftentimes, what I have experienced people meaning by that is it's more of a personal statement of, I don't see what gives Bitcoin value.
Right.
And underneath that,
I can't feel it. I can't physically possess it.
That's right. Like I've worked with a lot of blue collar folks in my day, and I grew up in a blue collar town. I still live in one, and they'll say something like it doesn't exist. And what they mean is, I can't touch it, taste it, it's immaterial. Right. And my thought was always, but does math exist? You can't eat math. You can't smell math, but you use it every day. So it became a matter of, okay, it's just people are unfamiliar with it. And that's the easiest way to say what it is that they're trying to express. But okay, going a step further, when people talk about utility value, like let's take real estate, for example. Real estate creates revenue. Like if I rent a house, the guys are paying me rent, so I've got an income stream. Bitcoin doesn't do that, but it doesn't try to do it. And so if we thought about gold in the same way, neither does gold. Yet people will still buy gold. But then the answer comes back, okay, but you can wear gold. So that's what gives it its value. You can make it into jewelry, etc. But that's not actually the reason that gold came to have value. That's a secondary reason over the years. Gold came to have value because of its intrinsic characteristics. You can verify it pretty quickly. It's relatively scarce, so on and so forth. Bitcoin came along and attempted to perfect those intrinsic qualities. And so when somebody says it has no intrinsic value, it's like, well, what backs Bitcoin? What backs gold? Gold is self-backing in that regard. And I would argue Bitcoin is self-backing in that regard. Because of its scarcity, for example, that's what gives it value. And the market disagrees Bitcoin has no value. It has no intrinsic value because Bitcoin's worth $80,000 a coin. That's not... So then there's all kinds of arguments, right? So then people say, okay, but that's a bubble. The answer is we have to argue it out and think it out and study it out, because we can't say, well, no, it's not a bubble. It's not going to be a bubble because we don't know the future. But what we have to do is just compare it to other assets and see how it stacks up in terms of its intrinsic qualities.
So let's talk for a moment then. You teed it up perfectly about it's too volatile comment. I mean, the 365-day low is 71 and change, and the all-time high, which was October of 25, was 126,279. How do we address that?
It's a great question. And I would say that all emerging assets are volatile at the outset. A helpful way to think about it is, I have a 3-year-old. He doesn't have as much emotional maturity and self-control as my 5-year-old does. And my 5-year-old doesn't have as much self-control as my 14-year-old does. And I can't speak to my 5-year-old like I do my 14-year-old and teach him life lessons. So Bitcoin and assets behave in a very similar way. Bitcoin is like a teenager right now. And so it's going to be volatile. That's just the nature of assets. Now, here's the thing. Somebody who wants to buy Bitcoin, like let's say that they listen to this podcast and they are just blown away and convinced that it's a great, they ought to buy it or whatever. They have to be ready for a peak to trough drawdown of just like what you said, an 80% dip. for example. And that's a tough one, man. That can be tough to swallow. That's partly why I built the downside risk mitigated portfolios that I built to help cut volatility out of Bitcoin. But I think at its core level, Bitcoin will not coddle you. You need to study it so that when it drops the next 80%, you know or are certain about your own conviction about it. So I don't even try to pretend that Bitcoin's not volatile. And then consider strategy stock. It's 1.5 to 2x as volatile. Sometimes volatility is okay, but it tends to freak people out.
Right. So to that, I think of a question of risk reward, pros and cons. I guess what I would say, even as somebody who's not advocating for this and supporting this, well, okay, what's the risk of having zero allocation to Bitcoin if it does succeed? What does that look like?
Well, that if it succeeds, meaning I don't want to define your terms for you.
It's a great question. Okay, does it become a staple of the digital asset in some case that does reinforce some monetary system? I don't know. I mean, I'm just thinking some extremes. What does the market look like when it can, if it does, decouple and actually works more like a digital asset like gold? It's a digital version of gold. Mm-hmm. These kinds of things. I don't know. It's an interesting question that I think about. In other words, I'm on family office. What happens if I don't? Maybe nothing. Ultimately the consequence may be nothing, but if I'm not in the game at least a little bit, what are the consequences?
Well, it's a thoughtful question because the US is in an unprecedented spot. Our debt is at an all-time high. I think real return on bonds is shrinking, and I think it will continue to shrink over the years. So what I mean by real return is take the interest rate that a bond is paying, subtract the inflation rate, and that's your real return. So if you're paying 4.5%, inflation is 3%, that minus that is your actual real return. If inflation is higher than 4.5%, real monetary expansion runs at, say, 6%, and you buy a bond, your real return is in the negative category. So it seems to me that is a very real possibility that as we go with longer duration bonds, real return is going to shrink and move into negative territory if it's not already there. And so take that as an example. Other assets can reprice to sort of outpace inflation. Bonds flat out cannot because you're locked into a contract. Bitcoin has an opportunity here as an asset that is outside of that system altogether. And so there are institutions that are beginning to ask that question of what is the risk of not allocating? Whereas before the question was, what is the risk of allocating? This thing is new. It's unfamiliar. It's scary. We don't know what it is. Now it's like Bitcoin seems to be vying for its place at the table as a grown-up asset. Now, having said that, we're very early. Bitcoin is a $2 trillion asset. Gold is a $16 trillion asset. Google is like a $1.7 trillion asset. So Bitcoin's making its way up the ranks as more and more money flows into it.
Right.
And that, I don't know, that's I can ask the question with you instead of answering it. What is the risk of not allocating? The risk is losing out on. Yeah.
Yeah. Look, some of these are just open-ended debates that aren't meant to be solved yet, but they are all good questions.
Yeah. Yeah. I mean, like if Bitcoin does what some people say it's going to do, then the risk is obviously that we miss out on the returns. But I think even if there are no returns to be had, let's say Bitcoin stays flat, the risk of not owning Bitcoin is not owning Bitcoin. That's how I'd put it.
So one question, and then I've got a few closing questions as we're wrapping up here. Is there a trade-off between self-custody and owning Bitcoin versus an ETF of owning Bitcoin indirectly?
Yeah, absolutely. And it's really a matter of pros and cons. So if I own Bitcoin in self-custody, and I'm not talking about owning it on Coinbase or another exchange, because that's not actual real self-custody. Self-custody is when I have my own keys and I'm the only one that can gain access to my Bitcoin. That type of self-custody, real self-custody, has a trade-off to the ETF. Okay, that means that if I lose my keys, that my Bitcoin is gone. So if I put $1 million in Bitcoin and I put my keys in my freezer, etched on a piece of metal, and someone comes and steals my freezer, my Bitcoin is gone. It's gone. So Bitcoin doesn't baby you. It's scary in that regard. And so you sort of have to up your game if you're going to hold your own keys. Now, people will outsource that ownership, and that's a legitimate approach. You can do what's called a 2 of 3 multi-sig setup, where there are 3 sets of keys, and you need any 2 of those 3 in order to access the Bitcoin. That provides some risk management because I can put 1 set of keys in my freezer and another one at my brother-in-law's and a third with my attorney. And now I've diversified my risk a little bit. But that's not the same thing as a traditional feeling wrapper, i.e. an ETF. If I buy an ETF, the ETF goes out on my behalf and buys the Bitcoin, and it itself holds the Bitcoin. I don't actually own Bitcoin, nor can I redeem my ETF shares for Bitcoin. I can only redeem them for dollars, for fiat. But it's more convenient. So if I only want to think about Bitcoin as a sort of trading asset, and that's fully legitimate, by the way, then I buy the ETF. Plus, Bitcoin ETFs aren't simply spot ETFs where I get one-to-one price action correlated to Bitcoin. Bitcoin ETFs are downside risk mitigated ETFs that cut volatility, cut the downside, and offer some of the upside exposure. So you can structure a portfolio to meet your risk appetite with ETFs. Whereas if I buy full on-chain Bitcoin, I'm going for a ride. Whatever Bitcoin does is what I do. So the right mix is different for everybody.
That's interesting. So let's a couple closing questions. Let's say we have a skeptical advisor listening to the conversation today, and they really were interested in saying, okay, I'm at least open to the idea that I'm going to do a little more due diligence and I'm going to take my time to do some more study. Like intellectually, I get it. I'm opening up my aperture here. Where should they begin?
Yeah, I respect the question that hypothetical advisor is asking, because that's different than where the industry has largely been in the past of poo-poo it and metaphorically flip at the bird and shut the conversation down. That's a little crude way of saying it, but you know what I'm saying.
Yes.
Where to begin? That's a good question. There are all kinds of resources where you can begin. You can just type into Google, Claude, ChatGPT, what is Bitcoin? You can read the white paper from Satoshi. My book is an excellent starting point. There are tons of other books from the Maxi Orange Pill Bitcoin community that break it down. There's the Michael Saylor Tucker Carlson interview, which I think is fantastic, or anything by Robert Breedlove. He went on Kitco at some point and spoke about Bitcoin. That's a good resource. So it's like seek and ye shall find. The finding it is not the hard part. The seeking is the hard part, which is why I said I respect the question to begin with. Once somebody switches from being a disrespecter of Bitcoin, not considering it, to an intellectually open position, that's all that's necessary. Then just go study it.
Yeah, that's a big win.
That's a huge win.
Yeah. For the paradigm to shift off of no, never, under any circumstance, to, okay, let me at least do a little more research here before I speak.
That's right. And to your point earlier, is Bitcoin polarizing? It absolutely is. So in some ways, those advisors who sort of flipped at the bird, like I said before, I understand why they would do that. It above any other asset class has it's very polarizing, and we could talk about why, but it has an extremely controversial element to it. And I think it's because of its fundamental characteristics. It's a challenging asset. It challenges people's core identities, core assumptions about themselves, life, even God. It's not just an asset in that regard. It's once you study it, you start to see, man, this thing is deep.
Yeah, absolutely. And that, look, to sum it up, that is the fear. That is the challenge that is ahead of Bitcoin and its future from a general standpoint. Let's talk a little about your book. Why don't you share with that, and for all those listeners that are tuned into this and open to learning more, like you said, this would be another place that they could do some research.
Yeah, thank you. I appreciate that. I'll just hold it up here since we have, it's called Bitcoin in the Family Office. And
Intelligent Introduction for the Affluent, the Ultra Affluent. Oh, right. Okay.
Yeah. And Richard Wilson from Family Office Club wrote the foreword. So that was very kind of him to do. My book is not properly an introduction, a zero to Bitcoin sort of discussion. I have a webinar that really it takes people from zero to Bitcoin that I love giving. But this book is written for somebody who has already put, let's say, 10 hours of study, maybe 20 hours of study into Bitcoin. But at the same time, they've got half $500 million and an investment mandate that restricts them by policy from buying an asset which has higher than a 50 vol. I'm just throwing out numbers. Right. So this book is designed to help bridge the gap, first in understanding, but second in governance and understanding of custody, so that they can justify why this is not just, in my opinion, a speculative asset, a crazy casino asset. It's an asset that actually deserves consideration from a monetary debasement point of view. And so I'm trying to bridge that gap for family offices they've got enough on their plate. They don't need to go become a Bitcoin, professor. I've studied enough and I love it. It obviously takes a specialist to want to get into this. It's tedious for a lot of people. So all of my books, I have a whole bunch more in that are forthcoming. They try to really make it palatable for people who would otherwise not be specialists in the field. Very good.
Okay, how else do you?
It's a lot of fun.
If someone was interested in reaching out to you, having a conversation with you, how can they? And if so, how do they do that?
We're not talking to people.
How do they do that? How do they get a hold of you?
Yeah, so people can email me at eric@veritaswealth.net. So Veritas is Latin for truth, Veritas wealth.net. My website is familyofficebitcoin.com. That's actually going live today, the upgraded version. Okay. So those are two areas, two ways in which people can, and you can find me on LinkedIn as well.
Congrats on the website and everything that you're doing.
Thank you.
It was a pleasure. Been fun. Very insightful. It has been fun. It's been enlightening and insightful, which is the
Thank you, Scott. Likewise, I appreciate your thoughtful questions.
Appreciate it, and look forward to talking another time.
Great. Sounds great.
Appreciate it, Eric. Have a great one. And to all of our listeners, thanks for tuning in. Cheers.
The Optimized Advisor podcast is intended for financial professionals only. The content discussed is for informational and educational purposes and should not be construed as financial, investment, legal, or tax advice. Listeners should consult their own professional advisors before implementing any strategies discussed. Views expressed are those of the hosts and guests and do not necessarily reflect the views of Optimized Insurance Planning or its affiliates.